When I was 20, I overheard two of my friends, Sean and June, talking about investing. We're at Sean's house, we're sitting at his dining table, and they're talking about investing and stocks and all these things. And me, at the time, I knew what investing was. I hadn't done it yet, but there was a part of me and my ego where I didn't want to admit that I hadn't started investing yet. And so part of me, I tried to engage and be a part of the conversation, even though that I hadn't really invested up until that point. Pretty quickly, they knew that I, wasn't an investor. And at the time, what the sticking point for me was that I knew I needed to invest. I felt like I didn't have enough money to invest. I also felt like I didn't have enough time to have to research stocks and figure out how the stock market worked. To me at the time, I was like, you know what, this is something that I'll figure out later. I'm going to put it on the back burner, and that's the reason why I didn't invest. Sean and June, in that conversation, told me that investing is actually not about picking individual stocks. They were telling me that they actually tried picking individual stocks and they actually made less money doing that versus just investing in something called an index fund. Okay, what an index fund is, it's basically a basket. Instead of having to pick like Tesla or Facebook or Meta or whatever it's called on the stock market, or Apple, or I don't know, instead of picking these individual stocks, what you can do is buy a basket of stock that has a small percentage of a bunch of different companies, like all the ones I just listed. Okay, that is called an index fund. And they were telling me that it's actually better to just invest in that because that is more proven and you'll actually end up making more money trying to pick a stock that will win. Okay, so that little insight there really changed my perspective on what investing was, because prior to that, my idea of investing was that, you had to have some insider information. You had to speculate what you thought you could buy low, and then eventually over time it's gonna, exceed in value and it's gonna make your money go up. That's what I thought it was. But what it is in actuality is it's just another place to park your money where you can get higher returns than putting in a savings account, for example. Okay. So if you do nothing with your money, if you hold on to cash under your mattress, you are actually losing money to inflation every year by 3%. So you're getting negative 3% every year. That means if you have $100 under your mattress, next year, that $100 is going to be worth $93. Okay. So you are losing money by holding on to cash. The next best thing you can do is put in a checkings account. Something like Wells Fargo or Bank of America or US Bank, whatever it may be, they will at least pay you 0.01%. So your $100 next year is going to be worth $97.01. So that's a little better, but not by much, but a little better. The next best option after that is putting it in a high yield savings account where you can earn about $3. Okay, so what that means is you are actually breaking even since inflation is -3. High yield savings account is going to pay you between 3 and 4%. So if you have $100 today, next year, if you put in a high yield savings account, you'll have $103. But due to inflation, your buying power is still $100. So it's break even. Okay. So from there, the next best option is to invest into the stock market. And this is where you get an average of 10% returns. So if you put in $100 next year, it'll be worth $110. But because of inflation, it has the buying power of $107, right? You see how that works? So investing really is very much like putting money in a savings account, except you put it into the stock market. You don't want to touch it, but it just sits there in a index fund, which is a basket, and you technically own like a tiny, tiny microscopic percentage of all the companies in the US on the publicly traded company in the US, and it just goes up. And that's investing. Right? It's not all glamorous like the way that Wall Street, like the movies picture, paint it as like, Wolf of Wall Street, where there's like giant monitors with green arrows and red arrows and like graphs that are going up and down. Like, that's actually not investing. That's trading, and it's a fancy version of gambling. Okay, what investing is putting your money into the stock market and knowing that on average, throughout the history of the stock market, it's always gone up, average of 10%. Okay, so how do you actually invest? What does that actually look like? Well, you want a minimum of $500 saved up that you can put into an investment account. So get to that point where you have at least $500. And then what you want to do is you want to open what's called a brokerage account. Okay. Ideally, you can go to like investing.com and then just like buy a company, and that would be the ideal way that things work out. Unfortunately, that's not how it works. You do need to open up something called a brokerage account. The one that I personally use is called Vanguard. So you can go to vanguard.com. I'm not sponsored by them. I don't get any kickbacks. I should, but I don't. So go to vanguard.com, and if you are currently earning money, you want to open up something called a Roth IRA. Okay, a Roth IRA is a type of retirement. It's a type of retirement account. It's a type of retirement investment account. And if you currently earn anything, if you earn any type of income, you can open one of these. And the benefit of this is that you can put in money that's already been taxed, but when you withdraw it, all of that growth on your investments is tax-free when you withdraw the money. Okay, so it's very, very powerful. The only stipulation is you have to have earned income in order to open this specific account. Okay, so go to Vanguard.com, open a Roth IRA, and you want to deposit a minimum of $500. The maximum you can deposit is $7,000 per year. And the government puts a cap on how much you can invest into a Roth IRA because it's that good. Okay. What I tell my clients is if you do nothing but just put $7,000 a year into a Roth IRA consistently every year, by the time you retire, you can retire a millionaire. If you do nothing else, if you just do this one thing, you can retire a millionaire. So I beg of you, if the only thing you take away from anything that I teach, let it be this one. Do your very, very best to max out your Roth IRA every single year, and you'll be taken care of for the rest of your life. Okay. So after you've opened the Vanguard account, you've opened a Roth IRA on Vanguard, you want to deposit a minimum of $500, a maximum of $7,000. And what you want to do is you want to buy an index fund called VTSAX, VT-SAX. VT-SAX is an index fund that covers the entire stock market. So I think there's about 3 or 4,000 publicly traded companies in the US currently. When you buy VT-SAX, you own a tiny, tiny, tiny percentage of every single publicly traded company in the US. And that's what that is. A common mistake people make is they open a Vanguard account, they open a Roth IRA, they put in $500, and they think that they're done. They think that's all you have to do. In reality, your Vanguard account and your Roth IRA is kind of like a wallet. So you want to put money in there, and then once it's in your wallet, you have to then buy the asset. Okay, so don't just put money in there and think you're done. You have to actually click on buy VT-SAX. Just by doing this one thing alone, I turned my initial $500 investment into what is today worth $108,000. Started off with just one investment of $500, is now worth $108,000. And by the time I retire, by the time I'm 65, it's on track to be worth a little over $3 million, as long as I consistently and continue to invest $7,000 per year until I'm 65. As long as I do that, I'm going to have a little over $3 million by the time I retire. That is the power of this. Okay, so please, this is the one takeaway. If you could just take one thing away from anything that I teach, you can ignore everything else. Just make sure you max out to the best of your ability the Roth IRA every single year, every single working year. Okay?